It's fair to say that the buy now, pay later stocks have had a difficult past year on the markets. Many of the ASX BNPL companies went from market darlings in 2020 to falling down the wayside and losing 50, 60, 70% of their value over the past year. Investors might be wondering, what's happening to the BNPL cohort? Why are companies like Zipco, Sezzle, Afterpay before the acquisition, Affirm, and many of these other companies continuing to trend lower and lower? In today's video, we're going to unpack the BNPL story. We'll do a deep dive into the sector and then talk about some of those headwinds that have been affecting the broader cohort, and then explore where the BNPL sector may head from here moving forward. Now, before we discuss some of these headwinds and these critical factors that are really affecting the buy now, pay later valuations on the market, I thought it made sense for us to do a bit of a dive into what is buy now, pay later and why did it attract so much attention in 2020. Buy now, pay later at its core is a new form of short-term credit that has revolutionized the payments industry. BNPL has often been described as the new lay-by, leveraging digital technologies to facilitate consumer borrowing at the point of transaction with almost seamless loaning to customers. Now, buy now, pay later loans traditionally take the form of pay in 4 installments. Generally, these BNPL loans are interest-free, which stands out as a point of difference versus conventional credit cards and other forms of loans. It was in 2020, during the lockdowns and the pandemic, that BNPL companies exploded into ASX and global technology investors' attention. If we cast our minds back to that year, we know that we were in a low growth environment, with lockdowns really affecting many industries around the world and investors searching for growth and almost willing to pay anything, really bidding up valuations in growthier sectors of the market. We're obviously an e-commerce focused society, with many businesses transitioning to an online focused model. And there was excitement surrounding a new sector that had started to have market validation and some significant growth rates. However, since that period, there have been a range of difficulties, a range of different headwinds to contend to, and of course, significant sell-offs across the sector. And that's now where we find ourselves today. And so, as I know that many people are familiar with, that leads us to today, where we've seen valuation compression across the sector for the buy now, pay later companies. Of course, we're in a period where rising interest rates and the inflation narrative is at the first and forefront of many broader macroeconomic discussions, and the BNPL sector has not been immune to that. We of course know the narrative that a rising interest rate environment is going to lift the discount rates used for the valuation models, and as discounted cash flows have an increased discount rate, of course that means that companies in the growthier end of the market with longer duration valuations, particularly those that are not yet profitable, are going to have a valuation compression. And so we've started to see that flowing through to many different sectors of the technology cohort, but the BNPL sector is one that's been definitely hard hit from that. On the other side of the coin as well, as we mentioned earlier in the video, BNPL sector really shone as a market darling when it was a low growth environment. Investors were willing to bid up companies in the e-commerce, in the BNPL sector, and in many of these other technology sides of the market where there was no growth to be had. If you think about the resources sector, if you think about the financial sectors, there was a lot of uncertainty about how things would play out. Consumer staples, nobody was sure about how and when foot traffic would return to stores. And so investors were willing to pay almost anything for companies that could promise growth. And of course, the BNPL companies had significant amounts of uplift. They continued to grow at that top line level. And this is where a lot of that excitement happened. But now the cohort has come into a range of different headwinds. And I think we can distill them down into 3 different factors: increased competition, regulatory overhang and risk of further discussion surrounding regulation, and then changing consumer demand trends. We'll unpack each of these 3 throughout the video, but if you do enjoy it, don't forget to hit the like button. Feel free to share it out, and if you're new here, welcome. Make sure you've subscribed and turned your bell notifications on as well. So I guess first and foremost, probably the one that's been at the front of investors' minds has been growing competition. I think it is worth noting that an increasingly competitive landscape brings validation for the product. And there's little doubt now that pay in 4 installments, buy now, pay later in one form or another is a product that's been validated and is one that consumers want to gain access to, and so it's going to continue to grow. We know that e-commerce penetration is still relatively low compared to where it will be in 2025, 2030 and beyond. And so as a result of that, consumers want alternative forms of payment, and BNPL is one way that they're hoping to continue to access that. However, the bigger question is, in what form will BNPL be delivered and who will be delivering it? We've experienced financial services companies entering the space. Commonwealth Bank is really top of the mind with that. We know that there's other technology names really interested in the space, including PayPal as well, and obviously Block with the recent Afterpay acquisition. And we do know that heightened competition can erode profit margins and take away market share for those incumbent providers. And we've started to see some uncertainties surrounding that as the increasingly competitive landscape picks up pace. And really that brings us to where we are today, where product and brand differentiation becomes more and more important. As the sector continues to expand, it's a way that incumbents and potentially new entrants will be able to stand out and continue to forge their piece of the pie that they want to take. And then building on the increasingly competitive landscape, there is that increased risk of regulation as well. Of course, in the earlier stages, as the BNPL sector was relatively small, there was a big focus on innovation there. They haven't really been at the mercy of many of the other conventional credit regulations, and so as a result of that, it's been able to grow. But we know that ASIC, as well as other global regulators around the world, including in the UK, including in the US, are taking more looks at the sector. And as the sector continues to expand, and it continues to have an increased consumer base, as well as, of course, continues to have new competitors entering the space, the risk of regulation continues to hang over it. We know that increased regulation, depending what form that it takes, can hurt profit margins or at least affect service delivery. And currently merchants are unable to pass on the surcharge to customers. If these surcharges were passed on, there could be an effect on consumer demand. So this is something that investors are going to continue to weigh up moving forward, particularly as the risk of regulation expands in years to come. And then on the third side as well is just that consumer demand side. We've talked about it already that 2020 seemed like that perfect storm for buy now, pay later and e-commerce demand. But as we move into this next stage of the economic recovery, as we move out of lockdowns and into this new normal, we've seen some interesting data and some interesting reports that we're transitioning from a goods-based to potentially a more service-oriented economy with this recovery. If you think about 2020, everybody was staying at home. You couldn't really go out for dinners all that much. There wasn't a lot of traveling going on. There was not a lot of service opportunities to be able to spend your money on. And so individuals were looking to spend their money on goods. Maybe they were buying more clothes, more items for home. Maybe they were buying some DIY things to work around the house while they were in lockdown. But obviously, as we get out of this period, people want to catch up with their friends, with their family, and do fun things that have missed out on over this past period. And obviously we know that traditionally the buy now pay later offerings have conventionally been used for much more goods based. And so this transition towards a service oriented economy will be interesting to see how it affects consumer demand. Along with that as well, we know that we've had an ultra loose fiscal as well as monetary policy regime. There's been significant stimulus as well. Household savings rates rose over this past period. They've had a second buffer as well with the Omicron variant. But of course, as we get back to a new normal, household saving rates will go down, discretionary income and spendable income will likely go down as a result of that. And then we also know that rising interest rates will potentially have an income effect as well. We know that mortgages are a staple of many individuals' household balance sheets in Australia. There's of course a significantly leveraged economy. And so with rising interest rates moving higher, this will have a potential income effect, which will mean there is again less discretionary income. And this could mean that there's less spending available for the goods that traditionally may have been first and foremost for buy now, pay later over the past couple of years. Of course, this is not to say that the buy now, pay later sector is going to slow to a halt. It is a sector that continues to grow. E-commerce penetration is very low compared to where it will be moving forward. And so as a result of that, it's likely that BNPL in one form or another will only continue to grow for years to come. But of course, with many of the growth rates that were plugged into models in, say, 2020 and the earlier parts of 2021, these have been challenged by these three different headwinds. And so this is why there's some uncertainty surrounding the sector now. And so, of course, the question goes, where to from here? I guess there's a range of different factors. We've talked about it. The sector will continue to grow, but investors are wondering who will be doing the delivery of BNPL. Will it be the banks or the incumbent financial institutions who may look to deploy 0% interest credit cards or their own BNPL offerings? Will it be broader technology and financial service institutions who may look to acquire some of these BNPL offerings or build them up internally, like PayPal have done with their Pay in 4? We do know that consolidation is likely to continue to play out. We've seen it with Afterpay and Block. Of course, there's rumours and discussions about Zipco and Sezzle as well for a merger. And there's many smaller incumbents. It's unlikely that all of them will make it through this upcoming period. And so consolidation is something that we're going to have to continue to watch for. We've talked about it earlier, product differentiation is going to be important. As we know, there's a significant amount of individual entrants that have got consumer-facing, paying for installments or their own derivative of this. And so product differentiation is going to be critical to have your offering be able to stand out in an increasingly crowded marketplace. A few of these different differentiations over the past period we've seen include BNPL virtual cards, partnerships, whether it's with banks or other service providers, loans and looking into different customer segments or geographical diversification, as well as building out the ecosystems as well to really entice both the merchants and the customer base to really leverage in and invest into your ecosystems. We know the companies will continue to scale. We know there is a significant growth runway ahead for the sector, but the question is, how will the individual entrants go within this? Of course, we can see that the investors have been voting with their hands and feet over this past period. There's been a significant downturn for many of these companies, and so investors will be wondering what happens from here. I'm keen to know your thoughts on it all. Drop in a comment below. Let us know what you think happened to BNPL from here. If you did enjoy this video, don't forget to hit the like button. Feel free to share it out as well. And make sure you've subscribed and turn your bell notifications on. Thank you so much for joining us. Before we finish up, a reminder that I'm just a bloke on the internet who likes talking about the market. Nothing we talk about is financial advice, and none of the stocks we discuss are buy recommendations. It's all just a general discussion that's hopefully an interesting starting spot for you to do your own research from. Thank you for joining us. Hope you've had a Thank you for joining us. Stay well and happy investing.